B. Manage investment portfolio. Investment portfolio management is a critical treasury responsibility that focuses on preserving capital, maintaining liquidity, and generating appropriate returns while supporting organizational financial objectives. Treasury professionals manage investment portfolios to ensure excess funds are invested efficiently within the organization's risk tolerance and policy guidelines. Portfolio decisions are influenced by liquidity requirements, cash flow forecasts, market conditions, interest rate expectations, and regulatory considerations. Treasury teams seek to balance safety, yield, diversification, and maturity structures when selecting investment instruments. Effective portfolio management improves financial flexibility, enhances earnings from surplus cash, and reduces exposure to unnecessary financial risks. Treasury professionals continuously monitor economic conditions, credit markets, and investment performance to support informed decision-making and maintain alignment with corporate treasury strategies. Treasury investment portfolios commonly include short-term and long-term financial instruments such as treasury securities, commercial paper, certificates of deposit, repurchase agreements, money market mutual funds, corporate bonds, and government agency securities. Treasury professionals evaluate each investment based on credit quality, maturity, liquidity characteristics, marketability, and expected return. Safety of principal is generally the primary objective because Treasury investments are intended to support liquidity management rather than speculative activities. Diversification across issuers, sectors, and maturities helps reduce concentration risk and improves portfolio stability. Treasury professionals also analyze yield curves and interest rate environments when determining appropriate investment durations. Effective instrument selection supports liquidity availability while optimizing returns within approved organizational investment policies and risk management frameworks. Risk management is an essential component of investment portfolio administration because Treasury professionals must protect organizational assets from market, credit, liquidity, and interest rate risks. Credit risk refers to the possibility that an issuer may fail to meet repayment obligations, while interest rate risk reflects the impact of changing rates on investment values. Liquidity risk arises when investments cannot be converted to cash quickly without significant loss. Treasury professionals establish investment limits, diversification standards, and maturity restrictions to reduce these exposures. Organizations often implement formal investment policies approved by senior management or boards of directors to guide decision-making and ensure compliance. Ongoing monitoring of counterparties, market conditions, and portfolio performance helps Treasury teams identify emerging risks and respond proactively. Portfolio performance measurement and reporting are important Treasury functions that support transparency, accountability, and strategic financial planning. Treasury professionals evaluate portfolio returns against benchmarks, policy objectives, and market conditions to assess investment effectiveness. Common performance metrics include yield, duration, weighted average maturity, total return, and risk-adjusted return measures. Treasury teams prepare regular reports for management, boards of directors, auditors, and other stakeholders to communicate portfolio performance, risk exposure, and compliance with investment policies. Treasury management systems and investment platforms improve reporting accuracy, automate monitoring activities, and provide real-time visibility into portfolio holdings and market values. Accurate reporting strengthens governance practices and supports informed financial decision-making across the organization. From a CTP examination perspective, candidates must understand the objectives, strategies, and operational considerations associated with investment portfolio management. Exam questions frequently assess the ability to evaluate investment alternatives, analyze portfolio risks, interpret performance measures, and recommend appropriate investment strategies under changing market conditions. Candidates should understand diversification principles, investment policy guidelines, maturity management, interest rate impacts, and the characteristics of common investment instruments. Knowledge of credit analysis, liquidity management, and risk mitigation techniques is also important for practical Treasury applications. Mastery of these concepts enables Treasury professionals to manage organizational investments effectively, preserve capital, support liquidity objectives, and contribute to overall financial stability and long-term strategic success.